I am joined by Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Danielle, thanks so much for joining. Great to have you.
Great to see you, Caroline. Good to be here.
Danielle, the Fed kicks off its two-day meeting today. The market, of course, is largely expecting it to hold rates steady, no change there. Is that the right call or a mistake?
Well, I think with all of the drama that we've had over the last few weeks and months, I think that there should be every anticipation of absolutely no action at tomorrow's meeting. I think the market's really going to be focused more so on dissents and how many dissents there are tomorrow.
What are you looking for from Powell on Wednesday? Do you think he'll open the door to a rate cut come September?
I do. I think that pressure is building from within the organization for him to do that. We've got fresh data in hand from the conference board that shows that jobs harder to get has continued to increase. We just got out quits data that showed that the number of Americans quitting their jobs has declined. The quit rate has declined. Those are all measures of job security or insecurity in this particular case, and we're seeing layoffs go up, in that JOLTS data as well. They pay attention to every data set, and I would anticipate that these would be serious subjects of discussion and debate at the meeting that starts today and ends tomorrow.
Okay, so because the Fed is data dependent, you think in terms of the economic data, it's slowed enough to warrant rate cuts? And what about on the inflationary side?
Well, it's interesting you mentioned inflation. Of course, shelter is the largest single input to inflation. We got out the Case-Shiller home price index this morning, CoreLogic Case-Shiller. On a 3-month annualized rate, we've kind of swung from a positive 1.6% 3 months ago to negative 3.73% on a year-over-year basis. Zumper also came out this morning showing that apartment rents have continued to decline. So that shelter disinflation impulse is just growing as a matter of time. And again, this will definitely be, among others, the subject of discussion because there are major offsets to any kind of initial impulse we're seeing in terms of inflation from the tariffs thus far.
Danielle, you've talked about some of the data points that warrant these rate cuts. You've also said that there's this quiet recession happening here in the U.S. What are those recessionary signs that you're seeing, and why is there a disconnect? Because so much of the narrative is around the Fed, at least until this point, achieving this so-called soft landing.
Well, it's interesting you asked because tomorrow morning at the meeting, they're going to have the latest revisions to quarterly payroll growth. We know that in the second quarter of 2024, for example, with the data that's going to be released tomorrow morning, that there were net job losses in the second quarter of 2024. We expect to see a continuation of that negative momentum that is demonstrating to the Fed when the U.S. economy entered recession. Of course, layoffs only begin after recession has begun. They're a lagging indicator. And the fact that we've seen net job losses begin more than a year ago, again, is going to be very problematic for a lot of the members of the Federal Open Market Committee who are leaning more dovish.
But Danielle, the conference board just released the consumer confidence report, and it showed that confidence actually rebounded in July. We're starting to see signs of strength in the consumer again. What do you make of that?
Well, I think what you're seeing in the read-through there, and again, if you look inside the conference board's report, the jobs hard to get measure actually increased. In other words, it's harder for American workers to get a job. What you're seeing is the disinflation start to come through these confidence reports. Same with the University of Michigan. We're seeing quickly falling inflation expectations on households' parts, which is fabulous news. It's great news for the U.S. household that really has been debilitated by a rising cost of living. But again, what you're seeing adds fodder, if you will, adds another element of argument for those who are dovish to say, hey, U.S. households are perceiving inflation as being lower going forward, but yet they're seeing the ability to secure employment actually getting to be rougher, tougher. So those are definitely in tension with one another. Tension is actually a word I bring up because that's a word that Powell has been using to discuss the tension between the inflation and the other dual mandate, the employment mandate that the Fed has to comply with.
Later this week, we will get additional readings on the economy with jobs data. We'll get inflation data. And then we also, of course, have a big week in terms of earnings with several mega cap tech names on tap. What do you think the stock market is most focused on right now?
I think the stock market right now is focused more than anything else on momentum, and the fact that there's a bit of an ironic trend going on right now, and that the institutional investors are finding themselves chasing after the retail investor, the tail wagging the dog, so to speak. The stock market has not been focused on the economy for some time now. And I think that until we see this momentum, the flows into the market begin to recede. And we are seeing that on some levels in exchange traded funds and mutual funds. But until we see a true reversal, I think right now the stock market is a reflection of momentum and flows.
And do you think that momentum continues with Meta, Amazon, Apple, and Microsoft all set to report earnings? We've seen a lot of a resurgence really in the momentum in big tech, not necessarily in terms of Apple, but with some of those other names. Will that continue, and will it continue to lead the market?
Well, the bar is certainly set very high for the names that you've just mentioned. But I think as long as there are remote beats on earnings, that we're going to see continued momentum. A lot of the big sell side investment banks have been putting out fresh reports about unforeseen before in the history of the market, all the way back to 1929, the level of concentration, where returns are coming from, and they're squarely inside of that smaller and smaller group of market leaders. And there's no reason to think, again, with the meme stock mania resurging, that there's going to be any pullback in momentum unless there are some serious disappointments.
No reason to think that, but given the fact that you think the economy is in this quiet recession and you're pointing to data that points to at least a slowdown, where should the market be trading right now, and where does it go from here?
Well, I think it's going to be a buy the rumor and sell the news type of thing. I don't think the market's actually going to appreciate it if we wake up on September the 17th and find out that the Fed indeed is going to be lowering interest rates, because that will be a recognition, if you will, of the slowdown in the economy. And I think that will be the first wake-up call for stock market investors, if you will. And that is indeed how history has tended to play out. When the Fed finally begins to concede to a slowing economy, the stock market does not appreciate it.
So bottom line, between now and year end, do we see more gains? Do we end the market higher or lower than where we are right now?
I think we see a tremendous amount of churn, and one of the areas that we're directing our clients right now is increased volatility. I think if there's one area of the market that is seeing serious suppression, it's the VIX index, it's the credit, the MOVE index. So I think that is where a lot of the action's going to be, whereas there's going to be a lot of churn in the actual level of the stock market going forward. But again, it all comes down to mentality, momentum, flows, and these are very automated functions that control well more than 50% of the behavior in the stock market right now.
Okay, we'll leave it there. Danielle DiMartino Booth of QI Research, thank you so much. Really appreciate it.
And thank you for having me.